All right, so I want to show you how I place an earnings trade on MasterCard. So first thing, I'll go on FinWiz. This is where I find out which stocks have earnings, and basically I'll go on Screener, and then I'll go market cap, anything over 10 billion. And then earnings date, I'll choose anything that has an earnings either today after close or tomorrow before market open. So today after market close, I'm gonna sort by market cap, highest to smallest, and I see that we have Google, Starbucks, Ford, but I want to do MasterCard, so I'm just going to look at tomorrow before market open, and there you go, there's MasterCard. So it's got earnings tomorrow before the market opens. So here's what I'm going to do. I'm going to log into my Questrade account first. I'm going to look up MasterCard. And then the way I like to play earnings, obviously there's many different approaches, but I'm just sharing the way that I like to play earnings is I'm going to do a put spread on MasterCard. So a vertical put, and I'm going to go 30 days away. So the closest expiration to 30 days away is May 29th. So it's a weekly expiration. It's not a monthly expiration. Usually the monthly expirations like May 15 or June 19, they have more volume, more liquidity. July 17, for example. But I'm only going to go, I want to go 30 days away. So I'm going to go May 29th, even if it falls on a weekly expiration. So as you can see, it's 31 days away. I'm going to click here anywhere on the put side. The order entry updates automatically. I'm going to look at what is the implied move for 31 days for MasterCard. So to get the implied move, I just get an estimate. I just look at the at the money value of the put and call option. So the closest thing I can get is probably 267.5. So I could see that it's worth around $14 for the put side, and the call side is worth about $13. So it's about $26. So I'm going to try to go $26 lower than the current market price. And the $26 lower than the current market price is about 240, right? 266 minus 26 is 240. So I'm going to choose a 240 strike and a 235 long strike. That's for protection. That's also to decide the buying power or the capital required for this trade. So it's a $5 wide spread. 240 minus 235 is $5. Since options represent 100 shares, so it's $500 of capital required to place this trade. But I'm going to sell the put at 240 and I'm buying the put at 235. So there's going to be a difference. The difference is a credit. And as you can see, it's going to be somewhere in between 5 and 235. So I can probably go collect $1.05, $1.10 maybe. Now, before I place the trade, there's one other thing I like to do is I like to look at earning stats. Now, this website does looks at the probabilities of particular stocks, how they perform after earnings. I think for the case of MasterCard, I think it's the last 15 years. So here I'm going to click on MasterCard and let's see how much data is provided here. So this is since 2006. So it's about 14 years or 13 years. So here's the stats for MasterCard. This is real stats based on 14 years of data. So in the past 14 years, out of 53 earnings events analyzed, 36 times MasterCard moved up after earnings. 17 times it moved down after earnings. So 68% of the time, it moved up after earnings. All right, so already there's an edge that most of the time it's going to go up, all right, based on the last 13, 14 years. And if you look at the chart here, or the table here, it's even more obvious that most of the time it goes up after earnings. And when it does go down, it doesn't go that much. And even if it does go down, it stays within expected move. The only time it went outside expected move was over here, 2013. Last time it went down was in 2019, but it was very small. 240, which is my strike, divided by 266, which is the current market price, is about a 10% move. So I'm pretty far from the expected move. So if I look at delta, which usually gives me an idea of the probability of in the money, that this strike will be in the money come expiration, it says here 27, 28, which is pretty high. So if at that strike the delta is 28, that means I need to collect at least, for the probabilities to make sense, I need to collect at least $1.40. Now I'm not going to collect $1.40 from this trade. So another way I like to make sure what the probability is I'm going to use IQ Edge, because with IQ Edge I could see the probability of in the money percentage wise, not just delta. So as I log into IQ Edge, it logs me out of the browser version. All right, so I'm gonna look up the option chain for MasterCard. It's already looked up. And then I'm gonna choose, am I on May 29th? Yes, so let's look at the 240 strike. That's a strike that I was looking at. It gives me 17%. So you see delta's 27, but the actual in the money probability is 17%, 18%. So at 18%, that means I would need to collect at least 90 cents for this trade to make sense, probability wise. So I'm gonna log back into Questrade because I don't like using IQ Edge. So I'm gonna log out of IQ Edge first. All right, so I'm gonna look up MasterCard again, go to vertical, expiration May 29th. I'm just gonna click anywhere here. Order entry shows up. I'm gonna choose the 240 strike. Looks like I should come closer as we're talking. The stock is going up. So anyway, so I'm gonna go 240, 235, May 29th. Okay, and I'm gonna try to see how much I can collect. Let's start it off at $1.25. And so my plan with this strategy is I'm not gonna wait till May 29th. My idea is after earnings is released, premiums come down in value. So there should be a contraction in the volatility. So I'll be able to close the trade for less than what I sold it at today in one day. So I don't plan on holding it for 30 days. I plan on closing it the next day. Now, the reason I have a 30-day expiry is in case things go wrong, it gives me time to manage. So what could go wrong? So if MasterCard opens a bit lower, let's say to 260, 255, I'm still safe. My strike is 240. If it opens to 250, 245, I'm still safe. If it opens way below 240, that's when I'm in trouble. And even if it opens below 240, I still have 30 days for MasterCard to go up. But what I'm going to do in the case that it opens below 240, I'm going to start selling call spread. So instead of selling the puts, I'm going to sell the calls. And the advantage of doing that is that I'm going to be collecting credit. So for example, if MasterCard's at 235 tomorrow, I'm going to sell a call spread at, let's say, 280, 270, depends where I can get premiums. So I'll sell a call spread as high as I can, as long as I can collect some decent premiums. And as time goes by, if MasterCard isn't going up, I'm going to bring the call spread closer to 260, for example, 260, 265. And if MasterCard is still below 240, I'm going to bring the call spread even closer, all the way to 240. I won't go past 240 on the call side. And this way I'm collecting premiums, reducing my max loss. Because as we stand right now, if I collect $1.25 from this trade, my max loss is $3.75, which is $375. I don't have to accept that. I could, because the $375 max loss will occur only if on May 29th, MasterCard is below 235. So I still have time to manage a trade, collect some credits from the call side to avoid max loss of 375. So by the time expiry of May 29 comes, I could have a max loss of only $100 instead. But that's worst case scenario. That's if MasterCard drops below 240 and stays below 240 until May 29. So that's why I like the 30-day expiry, just to give me time to manage the trade in case it goes against me. Okay, so I'm gonna put the order in now. $1.25 credit, MasterCard 240, 235. So send order. I'm gonna confirm sell to open one MasterCard May 29, 240. Buy to open May 29, 235. So it's 5 points away. $1.25. I'm asking for $1.25. It's not gonna get executed, but I'm going to adjust afterwards. And commission is $6.46. Send order. Let's see what happens. If I go to open, it's still there. So I'm gonna reduce it by 5 cents. Send order. And I'm gonna go back again to it, modify, send order. Now the reason the bid and ask is so far apart is because there's not a lot of volume and liquidity in this weekly option. Remember, I don't want to go lower than 90 cents, otherwise this trade doesn't make sense. So I'm gonna go to $1.10. And remember, my goal with this is to close the trade tomorrow when earnings is released. There'll be a contraction in the premiums, so I should be able to close the trade for maybe 50% profit. So if I sell it today for $1.10, I'll try to close it tomorrow for 65 cents. Now this is one contract, so represents $110 and $65 if I try to close it tomorrow at 50%. But nothing stops me from doing 2 contracts or 3 contracts or 10 contracts. But because depending on my account size, I don't want too much risk. So that's why I'm only doing one contract, just to get the strategy going, just to have more proof of concept that the strategy works, get comfortable with it. Once it's rolling, then I can start increasing my contracts if my account size permits. All right, so I'm going to reduce it now to $5. Nothing yet. So 240, 235, May 29th. MasterCard earnings, $5, not getting filled. Let's look again let's look at the bid and ask. So 225 minus 45 cents is what? Is it 180 divided by 2? So yeah, I'm exactly at 90 cents. So it looks like I won't be able to get more than 90 cents. Try $1. All right, final price. I'm going to leave it at 95. If it gets filled, it gets filled. If it doesn't, then it's not meant to be. But my goal now is if I collect 95 cents, I'm going to get out of the trade tomorrow for 45 cents, 47 cents about, hopefully. Sending order for 95 cents. All right, I'm going to leave it as is. If it gets filled, I'll update you tomorrow. All right, so that's basically how I do an earnings trade. Now, the reason I like to do the put side is because there's more premiums on the put side. Call side, I've been tested on the call side often, so I avoid selling the call side. And what I like about the put side is if it gets tested, the premiums go up in value because volatility of that stock goes up in value when it goes down. So it allows me to sell, when I sell calls or call spreads against it to reduce max loss, it's going to be worth more. And MasterCard, since we saw that 68% of the time after earnings, it goes up. So there's an inclination that it goes up after earnings. Most of the time it goes up after earnings. So that's another reason why I sell the put side for earnings trade. And why do I do 30 days and not just the closest expiration? It's just to give me enough time in case the trade goes wrong. Because if I do this week's expiration and MasterCard opens below my short strike, I won't have anything on the call side to sell. Who knows how far the stock will open below my short strike, and then I would have my max loss of almost $400. So I'm going to leave it at that. So if you have any questions, leave them in the comments section below. If you're going to open an account with Questrade to trade on the stock market, use my link below to get $50 in free trades. Thanks for watching.